Welcome, everyone. Today, we are going to be looking at merchant cash advances, those MCAs you hear about, as a way for small businesses to get funding.
Right.
We're going to be using a great guide for this. It's called the Ultimate Guide to Small Business Merchant Cash Advance.
Okay.
It's part of a series, the Bigger Bottom Line Ultimate Small Business Guidebook series, if you've heard of that.
Okay, yeah.
And the authors are Daniel and Matthew Rum.
Those names are familiar, yeah.
Daniel has been in small business consulting and financial strategy for, over 15 years, I think, something like that. He's helped tons of entrepreneurs figure out this whole world of funding and growth and all that.
Right.
And Matthew really knows a lot about financial technology, especially when it comes to finding new and innovative solutions that can, help small businesses and medium-sized businesses get the capital they need.
Yeah, so both of them have some really good experience that they can bring to this.
And they do. In this guide, they really make MCAs clear. But, the thing about MCAs is, at their heart, it's a business getting cash up front.
Yeah.
But, and this is the big but, it's not a traditional loan.
Right.
That's what throws people off. With a traditional loan, you've got interest rates that are fixed. But MCAs, they work differently.
They do, and that's an important distinction to make right from the get-go. The provider of the MCA, they get paid back a certain amount of your future sales. That's the agreement.
Yeah, it's like they're buying a piece of what you're going to make down the line.
Yeah, it's more like a piece of your future revenue, really.
So our mission, if you will, today is to try and remove some of the mystery around MCAs. We're going to dig into how they work, the good, the bad, the whole 9 yards.
Right, so that you listening out there can make those, informed financial decisions for your business.
Exactly. We all know access to money, to capital, is make or break for small businesses, right?
It really is, yeah.
And MCAs have become this pretty popular way to get funding fast.
Oh, for sure.
Okay, so let's dive into this whole other way of looking at business financing.
Sounds good.
So first things first, can we just break down the basic idea?
Sure. So at its core, it's an advance, right? An advance on what you're going to earn in the future.
Okay.
It's different from a traditional loan where you borrow a set amount and then you pay it back plus interest on that original amount. With an MCA, the company giving you the money, they're basing it on what they think your future revenue will be.
Got it.
It's like they're betting on you in a way.
And the way it works is quite different too, right?
Very different, yeah.
So you get this lump sum of money up front, and then you start paying it back. But the repayment, it's not like a fixed monthly payment.
No.
Instead, it's a percentage of your daily or weekly credit card sales.
Right, and sometimes, and the guide points this out, it can be a percentage of your total revenue, not just from credit cards.
Oh, interesting. So not just credit cards.
Right. So if you have a day or a week where sales are booming, your repayment is naturally going to be a bit higher.
Makes sense.
And, of course, the opposite is true, If things are slow, you'll repay less because it's all based on a percentage of what you're bringing in.
So it kind of adjusts ebbs and flows with your business, which is kind of different than that fixed monthly payment.
Oh, yeah, way more flexible. A fixed monthly payment, that can really be a burden, especially if you have, seasonal ups and downs.
Right. And then there's this thing called a factor rate.
Yeah, the factor rate.
That's instead of an interest rate, right?
Exactly. It can be a little confusing at first, but it's just a multiplier, really. Say you see a factor rate of 1.3.
Okay.
That means for every dollar you get up front, you'll end up paying back a total of $1.30. Simple as that.
So it's like a set multiplier to figure out the final amount you owe.
Pretty much.
Yeah, got it. So if we go back to the guide, Daniel and Matthew lay out these key points about MCAs.
Right.
Upfront capital, and that's tied to future sales, right?
Yeah.
And they look at your projected revenue, not just your credit score. Repayments go up and down depending on how your business is doing, and they use a factor rate, not an interest rate.
You got it. It's a very different way of approaching business financing.
It is.
Yeah.
Now, just to take a step back, this isn't like a brand new concept, right?
No, not at all.
These MCAs, they've been around for a while.
They have, yeah.
When did they first start becoming popular?
Well, the guide points out that it was really in the late 90s that they started to gain traction.
Okay, late 90s.
Yeah, think about it. Back then, a lot of small retailers and restaurants, they had a hard time getting traditional bank loans.
Yeah, the banks can be tough.
They are. Strict credit requirements, wanting all sorts of collateral. It was a real struggle.
Right, so the payment processing companies, the ones handling credit card transactions, they saw an opportunity.
Exactly. They already had access to all that data, the daily credit card sales.
Right, so they could look at risk differently.
Totally. They weren't so focused on credit scores. They were looking at what they thought the business would bring in down the line.
So they were the first ones to really jump into this MCA game.
They were. And then as e-commerce started booming and people used cards more and more, even in regular stores, we saw these independent MCA providers pop up.
Right, so the early 2000s, that's when things really started to change.
Right around then, yeah. And then you can't forget the impact of the 2008 financial crisis.
Oh yeah, that was a game changer for everything.
It really was. Traditional lending just dried up. It became so much harder to get loans.
Right, so businesses, they were desperate for other ways to get the funding they needed.
Exactly. And the MCAs, they really filled that gap.
And they kept evolving too, right?
They did. It wasn't just about credit card sales anymore.
Right.
Providers started looking at cash sales, bank deposits, the whole picture.
So it wasn't limited to just certain types of businesses anymore.
Right. Way more businesses could tap into this.
Mm.
And then along came all this cool technology.
Oh yeah, technology has changed everything.
It really has. Data analytics, automated underwriting, all of a sudden approvals were happening so much faster.
Right, and businesses could get the money they needed in a matter of days, sometimes even the same day.
Crazy, right?
It is. But, all this rapid growth and the way MCAs work, it hasn't gone unnoticed.
Yeah, there's definitely been some scrutiny.
The guide talks about how the potential high costs and the lack of regulation have become big issues.
They have. It's become a hot topic.
So let's recap those key takeaways from the history of MCAs.
Okay.
So they emerged as this alternative to bank loans in the late 90s. Right. They just exploded after 2008 when getting traditional loans was like almost impossible.
Yeah.
Technology made the whole process smoother and faster.
Much faster.
It's not just for retail and restaurants anymore. All sorts of businesses can use them.
Yeah.
But now the regulators are really starting to pay attention.
They are.
Okay, so let's talk about who these MCAs are actually for.
Yeah, who are they really designed for?
The guide talks about accessibility and flexibility. So it sounds like they could be a real lifeline for businesses that can't meet all those strict rules the banks have for loans.
They can, and that's a huge point that Daniel and Matthew Rung make in the guide.
Right.
MCAs are more accessible, because they don't focus so much on perfect credit scores or wanting tons of collateral.
Yeah, and the banks take forever to approve a loan.
Oh, yeah, the paperwork, the back and forth, it's a long process.
So MCAs can be much faster, which is great if you need cash quickly.
Right, like if you have an unexpected expense, or maybe your income is seasonal and you need a boost during certain times.
Right, or maybe there's big opportunity, but you got to act fast.
Exactly. Those are all situations where MCAs can really shine because they can get you that money quickly.
So they're flexible in terms of when you can get the money, but the way you pay it back is flexible too, right?
Yeah, that's one of the big selling points.
Instead of fixed monthly payments, like with a loan, you're paying back a percentage of your daily credit card sales.
Right, and it adapts to your business. Some days you might have more sales, so you repay more. Some days it's slower, so you repay less. It matches your cash flow.
It makes a lot of sense.